Every empire hides its battles. In the world of finance, one of the quietest yet most consequential wars has been fought not with armies or weapons, but with interest rates and bond yields. For nearly a century, one signal has foretold every major recession: the yield curve. When it inverts, recessions follow. That pattern is held through the Great Depression, the stagflation of the 1970s, and the global financial crisis of 2008. But now, something has changed. The same curve that once screamed danger is being bent, twisted, and reshaped by forces it was never meant to confront. This is the hidden war between central banks and the most trusted signal in economic history. To understand this conflict, we must first understand the weapon itself. The yield curve is the relationship between short-term and long-term interest rates. In a healthy economy, long-term rates are higher, rewarding investors for locking up their money for years. But when the curve inverts, when short-term rates rise above long-term ones, it signals trouble. It means investors expect the economy to slow down, inflation to fall, and the central bank to eventually cut rates. The inversion is the market's way of saying, recession ahead. For decades, this signal has been nearly flawless. Every U.S. recession since the 1950s was preceded by an inversion. Economists have called it the economic crystal ball. But even oracles can lose their power, especially when someone starts rewriting the rules of the game. That someone is the central bank. To many, the Federal Reserve, or its counterparts in Europe, Japan, and China, represents stability. It sets interest rates, controls inflation, and keeps credit flowing. But its power goes deeper than most realize. Central banks are not just referees. They are active players in the bond market. Through programs like quantitative easing, they buy massive quantities of government bonds, suppressing yields and distorting natural price signals. After the 2008 crisis, the Fed's balance sheet exploded from under $1 trillion to nearly $9 trillion. In Japan, the Bank of Japan became the single largest holder of the country's government debt. These interventions, while designed to stabilize markets, have an unintended consequence. They reshape the yield curve itself. The warning light that once flashed red before every crash now flickers in the fog of monetary manipulation. To see the full picture, we must travel back in time. In 1929, the U.S. experienced the first modern yield curve inversion before the Great Depression. The banking system was fragile, and credit was tightening. The market sensed collapse before policymakers did. Fast forward to 2006. The yield curve inverted again. 18 months later, the housing bubble burst. The global financial system nearly imploded. Each time, the message was the same. Tight credit leads to economic pain. But in today's economy, that message is harder to read. The bond market no longer reflects only supply and demand. It reflects the intentions of central bankers who can print, purchase, and distort at will. The invisible hand of the market has been joined by the very visible hand of policy. The turning point came after 2008. Facing collapse, central banks began unprecedented bond buying programs. These purchases artificially lowered long-term yields, flattening the curve even in times of growth. The signal was no longer organic. It was engineered. A yield curve inversion once meant investors expected a downturn. Today, it may simply mean the Fed is playing a larger role than ever before. This blurring of meaning creates confusion. Analysts debate whether the current inversion is real or fake. Some argue it still predicts recession because the underlying forces, tight credit, falling expectations, remain. Others believe the signal is broken, drowned out by trillions in artificial demand from central banks. Both may be right. The yield curve still reflects fear, but the source of that fear has changed. In 2025, the inversion is deeper than at any time since 1980. The short end of the curve, driven by central bank rate hikes, stands high above the long end, which remains suppressed by institutional buying and global capital flows seeking safety. The data screams recession, yet unemployment remains low and markets continue to rise. This contradiction lies at the heart of the war. Central banks are trying to manage expectations, to convince the world that growth can coexist with tight monetary policy. The bond market, meanwhile, whispers a different story. One of slowing momentum, rising debt burdens, and fragile confidence. Each side interprets the other's moves, reacting in a feedback loop that defines the rhythm of the global economy. This war is not new, only more visible. In the early 1980s, Paul Volcker's Federal Reserve waged its own battle against inflation, pushing rates above 20%. The yield curve collapsed, signaling deep recession, and one followed. But back then, the signal was pure, untouched by manipulation. Today, every move is shadowed by intervention. Liquidity injections, forward guidance, asset purchases, all act as tools of influence, distorting the natural flow of information. The result is a world where the bond market and central banks are locked in a constant game of chess. Each action, a rate hike, a policy statement, a bond purchase, moves expectations. But unlike in the past, the market is no longer an impartial observer. It is a participant shaped by those very policies. The referee has joined the match. Critics warn that this interference may come at a cost. When central banks suppress yields for too long, they create false stability. Investors, lulled by low rates, take on greater risk. Corporations borrow excessively. Governments expand debt without consequence. The yield curve, muted by intervention, can no longer signal danger until it's too late. The longer the warning system stays distorted, the greater the eventual correction. It is as if we've silenced the alarm while the fire still burns beneath the surface. And history shows what happens when warnings are ignored. The longer the illusion of stability persists, the sharper the reckoning that follows. The Great Depression, the dot-com bust, the global financial crisis, all were preceded by moments of collective disbelief. Each time, the data was clear, but belief in policy was stronger. Today, central banks face a paradox of their own making. To keep economies stable, they must intervene. But by intervening, they undermine the very signals that allow stability to exist. The yield curve, once the most reliable indicator of risk, now reflects policy experiments rather than market wisdom. Yet the irony runs deeper. Central banks themselves rely on the curve to guide decisions. They study its shape, its slope, its historical meaning. In other words, policymakers manipulate the same signal they claim to monitor. It's like a doctor prescribing medicine while measuring only the effects of their own prescription. The result? Distorted feedback loops that make true economic health harder to assess. Some economists argue that the yield curve hasn't failed. It's been weaponized. Central banks understand its psychological power. When the curve steepens, optimism rises. When it flattens, fear spreads. By controlling expectations, they control behavior. Every speech, every rate decision, every bond buying program becomes part of a broader strategy of narrative management. Markets no longer respond solely to data. They respond to confidence. The war is as much about perception as it is about policy. And as long as investors believe that central banks can prevent collapse, the system holds, until inevitably it doesn't. If you're finding this exploration valuable, take a moment to support content that goes beyond headlines. Hit the like button. It helps this message reach others who want to understand the hidden architecture of finance. Subscribe for more investigations into the forces shaping our economic reality. And share this video with someone who still believes markets move by chance. The truth is far more complex. Looking forward, one question dominates. What happens when this war reaches its limit? Central banks cannot print growth forever. Each cycle of intervention requires greater force, larger balance sheets, and deeper manipulation of signals. Eventually, the system reaches a point of exhaustion. The yield curve, suppressed and distorted for years, may erupt back into honesty, its next inversion no longer muted by policy, but amplified by it. When that moment comes, the correction could be sharper than any in modern history, because beneath the surface, the forces of the market have not disappeared. They have only been restrained, and when restraint breaks, equilibrium returns with brutal precision. The lesson of history is clear. Every attempt to outsmart the cycle ends the same way. The Great Depression followed speculative excess. The 1970s followed monetary complacency. The 2008 crisis followed financial innovation gone too far. Today, the danger lies in our belief that we can manage cycles indefinitely. Central banks have become both guardians and gamblers, stabilizing the present at the expense of the future. The yield curve is not their enemy, it is their mirror. It reflects not just economic expectations, but the credibility of policy itself. Perhaps the yield curve has not lost its power at all. Perhaps it is warning us once again, this time, not just about a coming recession, but about the fragility of the system that seeks to silence it. History doesn't repeat, but it rhymes. And the curve's message, though distorted, still echoes. Imbalance demands correction. The hidden war between central banks and the yield curve is not about data points or charts. It's about control. Who shapes the future and at what cost? The more we fight the natural rhythm of markets, the more powerful the eventual reckoning becomes. When the next downturn arrives, we may finally realize the signal was never broken. It was only buried beneath our own ambition.